Hi, everyone. This is Jason Burak of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's a hedge fund manager that has over 30 years of experience professionally trading and investing in markets, both long and short. He runs a hedge fund, Barron Asset Management, with Bill Laggner, who my listeners may also be familiar with. And his credentials include successfully shorting the technology bubble in the late 90s, early 2000s, and also the 2008 financial crisis. He was heavily short that, and I believe he was featured in Barron, so him and Bill got a write-up there. So, Kevin, thank you for coming back on.
Thanks for having me, Jason.
So, Kevin, let's talk about central bank balance sheets now and your overall view of the global macro situation, because I've been saying this for the last couple of years that the global economy is one giant cluster clock, but it seems like the central banks just kept papering over things. Do you think that's starting to come to an end?
I hope so. We had this experiment in pressing rates for really an unprecedented 7 years. The Fed funds rate was at 0.25% or lower for a 7-year period. And I think the last bubble, the credit bubble, we never got rates that low, but the period where rates were suppressed was about 2.5 years. So we've really never seen anything like this. And we went from, at the tech bubble, total global debt was about $70 trillion. It went up to, in the credit bubble, in the 2006, 7, 8 period, went up to 150 trillion, and today we're at about 250 trillion. So, and now the central banks, and of course, I think the other big difference this time, not just that unprecedented 7-year period, but also the fact that China really got into the game in a big way in 2009 and 2010, and then you also had the central banks really acting in concert, almost tag teaming each other, where the Fed really started out being very aggressive, and then it was the ECB and the Bank of Japan. But now we are in the period of time where this is starting to reverse, and we've never seen this kind of balance sheet runoff where the Fed is now tapering to the tune of $50 billion a month, and now you have the ECB, their hands are tied. And what's interesting about this, Jason, I think is, you're starting to see some cracks in the Eurozone. For example, in Italy, you've got industrial production was down 2.6% in November. In Germany, industrial production was down 4.7%. So you're starting to see some cracks, and you're also seeing some price inflation. A lot of this monetary inflation went into technology, went into disruption, and was collapsing pricing models. So this is the thing. One of the things about monetary inflation is it's very difficult to kind of predict where it's going to go. And this time it went into basically asset inflation, but it didn't go into price inflation. Now we're starting to get a normalization of rates, but we're also seeing price inflation. So you're seeing, like for example, in Germany, the CPI year over year 1.7%. In France 1.6%, and yet the bond market, bond yields in Germany, the 10-year yield is 20 basis points, and in France it's 60 basis points. So I think we're starting to see these cracks. We're starting to see a normalization in rates, and I'm not sure that the system is designed to go in reverse.
Yeah, I completely agree. There was a small drop in credit in a short amount of time in like 2008, 2009, and that little drop credit is what helped accelerate, the 2008 financial crisis. You brought up Europe. I think Europe, like the U.S., obviously has enormous long-term debt problems, unfunded liabilities, the government shutdown. I mean, we could go on and on about the U.S. problems, but does it seem, Kevin, that the market is kind of giving the U.S. a temporary pass and is more worried about the European Union right now with European government debt, with European banks, and with the social unrest, that the protests and all that stuff that's going on in France and some of the other European countries?
Yes, exactly. And you look at the big European banks, Credit Suisse, Deutsche Bank, UBS. The stocks have been down, quite a bit of course, they rallied after the financial crisis and all the bailouts, but it's been all downhill since. And then there was a pretty good rally that peaked in January of last year. Those stocks got cut in half from January to December, and we've had a little bit of a dead cat bounce. They're up on average about 15% 15-20% off the Christmas lows. But I mean, there appear to be something is going on here, and you never know where the first cracks are going to necessarily come from. In the credit bubble, obviously they came in the housing area and in subprime, and this time some people are calling this the everything bubble. The cracks can appear from just about anywhere, but they do appear to be coming from Europe.
Yeah, I would kind of label everything, all these credit bubbles and asset bubbles, basically like economic landmines. So I think there's like an economic landmine for passive investing in this ETF bubble, because basically for 10 years, Kevin, you've had the average retail investor outperform most professional money managers and hedge fund managers. And over long periods of time, I mean, the odds of that happening are just very, very low. I know how much work you and other professional money managers spend doing the research, and for active management to really underperform compared to like just index funding, I don't think that this is going to be the new normal going forward.
Yeah, we had since 2009, $2.5 trillion flowed out of active fund mutual funds and ETFs, and $2 trillion out of active and $2.5 trillion into passive strategy. And this is a little bit reminiscent of the tech bubble, where we had a big swing out of equity income funds and bond funds and into really value funds, and it was into aggressive growth funds, technology sector funds, growth funds, that sort of thing. But the swing back then, I think, might have been $100 billion. The swing this time, now $100 billion over, let's say, a year. This time it's been $4.5 trillion over a 9-year period. $500 billion a year. So this area is it's leading to some of the short ideas that we've got, like BlackRock. But I guess we can get to that later. But back to the idea of outperformance, and every bubble is different. It's funny how you go back to the tech bubble, and that was the do-it-yourself. That was, hey, it's so easy. All I have to do is go out and buy tech stocks, go buy the latest .com stocks, and stuff our portfolio with that. This is the hands-off bubble. This is the autopilot. It's now what's easy is you just put it in an S&P 500 index fund. And I think you're right, Jason. It's not going to work. And one of the stocks that if you look at the FANG stocks plus Apple, starting this period, this bull market, they made up about 3% of the S&P 500, and they went up to about 12%. So that's a huge driver when you have large companies that are doing backflips for a long period of time and really driving the economy. I'm not sure that that's something that gets repeated. And now these people that own the S&P 500, what do they own? They own the huge tech behemoths like Microsoft and Amazon and Apple that got up to $1 trillion market caps. It's really hard when you're a $1 trillion market cap. What are the odds that stocks are going to outperform over the next 10 years? They're probably going to underperform. And then you look at some of the other big stocks in the indexes like Procter & Gamble, ExxonMobil, Coca-Cola, now AT&T. Of course, AT&T is not quite as big a weighting as some of the others, but if you look at the last 10 years, Procter & Gamble, their revenues are down 20%. So they're dealing with changing consumer taste, and they're just these companies, as they get this big, they kind of hit a wall, and I don't think people really appreciate this. So I think it's safe to say that the S&P 500, where everybody has gone, is probably not the place to be over the next 10 years.
That's interesting about Procter & Gamble. I actually didn't know that. So if their revenue is down 20%, Kevin, then they cannot handle the same debt load, and I guess that's similar to what happened with General Electric, right? Because General Electric was doing financial engineering. They were using massive amounts of debt because their credit rating was a lot higher than it should have been, and so they were buying back shares with debt. They were doing leverage buyouts, and then when their revenues fell, that's when they got in trouble, right? Because they got their credit downgraded, and then they couldn't handle the debt burden that they had, assuming that they would have higher cash.
Yes, exactly. And I think you hit the nail on the head. General Electric is kind of the canary in the coal mine. You look at where all this debt has gone and the monetary inflation. It's been public debt and it's been corporate debt primarily. The last cycle was mortgage debt, consumer debt. But those are really the big areas. And I think what's happened is a lot of these companies, like Procter & Gamble, their gross profits over the last 10 years. Now Procter & Gamble has actually paid down some debt. They paid down about $8 billion in debt over that time. But what's happened is I think some of these big companies have been a lot of them filling holes with financial engineering. And so you look at a company like AT&T. AT&T over the last 10 years added $112 billion in net debt. They were able to actually maintain their gross profits. They grew by 1.5% a year. But what was happening was their businesses were declining, and they kept on making acquisitions. And of course, for the acquisitions not to be dilutive or for them to be accretive, they had to buy basically declining business. And so they were raising the dividend over that time. Another example of this, ExxonMobil. Now it's a tough comparison because if we go back 10 years ago, this was when crude oil prices hit $140 a barrel, and so some of this is just natural as a result of oil prices coming down. But their revenues, their gross profits have been cut in half over the last 10 years. The gross profits have dropped 7.25% compounded annually over that time, while they raised the dividend 5%. And you can just go down the list. It's interesting. Procter & Gamble, their gross profits declined 2.5% per year compounded, while they raised the dividend 4.3%. So I think you get a picture here in terms of the financial engineering. That's what really was enabled by this long period of suppressing interest rates. And are you going to be able to repeat that over the next 10 years? I don't think that's going to happen. I just don't think these companies can continue to play these games. And of course, a lot of this stuff gets exposed as rates are normalized.
So Kevin, hedge fund managers like Bill and yourself and others are going out there and looking through the financial statements and maybe looking at the bond maturity dates and the cash flows for trying to find the next General Electric. And also a follow-up question, if you could maybe speak about this too. Do you place a lot of blame on the three major credit rating agencies, so Moody's, S&P, Standard & Poor's, and Fitch, for not downgrading these large corporations with their credit ratings years ago?
I don't know. I was very critical of the rating agencies. The last cycle they were, but this is really caveat emptor. Jim Chanos talked about this. The rating agencies just have a history of being late on this stuff. We can certainly be critical of that, but anybody who's really paying attention is not really relying on the rating agencies for their analysis.
So you and Bill are doing research, then looking for the next General Electric probably over the next couple of years?
Well, what we're trying to do is look at where we see the certain trends, where we see areas of vulnerability. We talked about the passive bubble, and we like to see companies that have they're just in tough, really competitive businesses, and I think the ETF business and really the passive management business is it's sort of a race to the bottom in fees. There's a tremendous amount of fee compression, and what you're seeing is BlackRock. I don't have the figures in front of me, but they were the biggest. BlackRock was first in terms of inflows last year, and Vanguard was second. And despite that, they are their fees. What's happening is you're seeing so much competition in terms of fees, and so investors are actually leaving. They're pulling money out of, like, for example, in emerging markets, the symbol EEM. They're pulling money out of EEM, which has a high expense ratio, and they're putting it into IEMG, the core. This is their core emerging markets fund, and the difference in fees is it's something like a 70% drop in fees. So it's a tough. This is a thing that's been going on below the surface, but of course what's been covering all this up has been the boom in passive investing. So and it trades at BlackRock trades at a substantial premium of course, to other active managers. So, that's something that we look at. But we're looking at a lot of different trends, and we try to position ourselves like the consumer is stretched. That's a trend. So we want to be long discounters, and we want to be short credit extenders. Whether it be credit card companies or banks. Auto finance is another area.
Yeah. So it sounds like you're shorting consumer discretionary spending then, because we're seeing credit card numbers actually increase, but the consumer is getting strapped. So I think the consumer discretionary spending is finally starting to hit a wall.
Yeah. Absolutely, absolutely, and also just demographically, you've got the debt levels, you've got demographically the baby boomers. They should have been basically getting more and more conservative and saving more over the last 10 years, and I think this is another consequence of what happened with artificially low rates is that they were penalized for saving and they were encouraged to take on more risk. So I think we have going forward, we have a real problem in terms of the baby boomers and their consumption levels are going to be going down. The question is, from the millennials, they're going to be moving into their higher spending years, and is that going to be enough to pick up the slack? And with student debt levels at $1.3 trillion, and also with the Social Security system, they're going to be relied on to pay into that. So they're going to, if you look at outlays as a percentage of GDP, they were 10 years ago 11%. They're going to go up to 15% over the next 10 years. So this generation has to basically, they're going to be expected to pay for that. And so I just don't see where consumption. I think consumers are going to be stretched in the U.S. for a long time.
The Generation Z that's graduating college now or just recently graduated, it seems there's very little moderate. So if you look at the surveys, a lot of them actually prefer socialism, and that's probably because they have so much student loan debt, they can't find a good job, their standard of living they see is going to decrease a lot from their parents. So the politicians that are promising them more and more free goodies, which is what a socialist politician will do, will promise people, in exchange for their vote, they'll promise them more and more free stuff. The other thing is there's also, according to some surveys, there's some Generation Z people that are more conservative. So there's very little people in the middle. I see, rising of basic radicalism.
Yeah, you look at the popularity of who's it, AOC, Ocasio-Cortez. And then you look at what Elizabeth Warren, and she's running for election in 2020, and you just kind of scratch your head about what are these people thinking. The first words out of her mouth are, "We're going to tax the rich," and there was talk about this in Davos apparently, and I mean, look at Venezuela, for crying out loud. I mean, it just doesn't work.
Look at France too.
Yeah. But I don't know. It's going to be interesting. I thought this week what was going on with the whole thing with the Covington Catholic high school student incident. That was pretty bizarre because it kind of shed light on this whole political correctness movement, and there is, you talk about a delusion, extraordinary popular delusions, and the madness of crowds. This thing has been building for a long time, and that may end up being a needle that pops that. I don't know. I mean, I think we have a long way to go, but it's going to be interesting to watch this just politically play out over the next couple of years. I don't think it's a given that everything is going to go in the direction of, we're going to have Bernie Sanders or Ocasio-Cortez in the White House in 2 years. So it'll be very interesting to watch it play out. But I think you're right there. The education and the seeds that have been planted from that, we still have to see those. See that come to fruition and bear some pretty ugly. We're already seeing it bear some ugly fruit, but that's kind of baked in the cake.
Yeah, from a historical standpoint, I'm seeing a lot of the same mistakes from the 1920s and 1930s that took an entire generation to learn those painful lessons. It seems that now, over 80 years later, those lessons have been forgotten, and a lot of the same mistakes are being remade again. But this week, Kevin, we had two hedge fund managers that are not libertarian or Austrian school. We had Todd Harrison, former hedge fund manager, former trader, and then also Marc, and they came out and they started tweeting at like the SEC, calling out the Trump administration, the Treasury Department, large Wall Street banks after the Mnuchin meeting, the emergency liquidity meeting, saying that there was market manipulation. So what's your views on that? Do you see that there's on an intraday basis just a lot more intervention then by maybe the central bank or a plunge protection team? Do you think that there's an attempt to do more market intervention than in the past?
I don't really know the answer to that. I mean, I kind of just look at what is obvious, and obviously there is a concerted policy to suppress interest rates that happened for 7 years. We're getting a normalization right now. We're going to get the consequences of those policies, and I think the central bankers are certainly committed to seeing all that through. They're not going to, they'll be the last ones to admit that they made a mistake, and we're just going to have to watch this all play itself out. I think the best we can do as investors is try to protect ourselves and own some gold, look for opportunities. I mean, this is definitely creating opportunities, both on the long side and the short side.
So do you think then, based on what you said with interest rates normalizing, you would expect what Jeff Gundlach is saying, how he expects the yield curve to steepen? You don't expect the yield curve to get even more inverted then?
I expect credit to get tighter. That's what I expect. Jeff Gundlach in the Barron's roundtable, he mentioned, he talked about corporate debt and the problem, and that last year $50 billion in corporate debt matured, and this year it's going to be $700 billion. So credit's going to get tighter. There is a whole bunch of debt at right above high yield that is probably going to get downgraded, and there was the high yield issuance was actually quite low, and there was no issuance in December, which first time that happened since November of 2008. But so that's one of the things that we're looking at. Companies that have been sort of binging on this high yield debt, like a Tesla or Bausch Health. You look at these companies. Bausch Health was formerly Valiant, so they went on the acquisition binge, took on massive amounts of debt, and you just look at a company like that, and you look at their balance sheet, and as rates go up, they're essentially toast.
So we're recording this interview on Friday, January 25th, and the oil price is WTI's at $53.69, Brent crude's at $61.64. You're in Texas. You talked about high yield debt. My impression of the oil market, especially the U.S. shale oil producers, is they sold enormous amounts of equity to like private equity, pension funds, some mutual funds, but they've also been beneficiaries of that artificially low interest rate that they've been gorging on the junk bond debt. So do you think that we're very close to having like a big oil bust in U.S. oil companies, maybe Texas, Oklahoma, North Dakota?
Yeah, I'm not really sure, Jason. Quite frankly, we really don't have a horse in that race. It's something we're just sort of watching from the side. Certainly that happened, back in 2015, 2016, there was a pretty good bust and a shakeout, and then the rebound back. But we really just don't have a position there right now. I mean, there's so many targets on the short side that you can only do so much.
So Jim Chanos has talked about China, and I've been researching a lot about China. Jim Chanos said that almost half of their GDP now is in speculative real estate construction. Do you think China is going to have like something similar to a 2008 financial crisis then with their housing bubble, and how there's just an enormous amount of, I think there's over 50 million, there might even be over 65 million empty houses at this point in China? Yeah,
China kind of reminds me a little bit of Japan in the late 1980s. This idea that the government could, the central planners could manage an economy, and I mean, there's certainly a lot of entrepreneurial activity in China. It's not all negative, but the debt levels are definitely concerning. The financial system is concerning. I mean, we're short China financials through an ETF symbol CHIX. We're definitely negative on what's going on in China.
Yeah, the copper price is.
Yeah, just another potential area where cracks can form.
Yeah, I think that the Chinese credit bubble is still growing. I mean, at some point with their GDP falling, they could get to a really ridiculous debt to GDP ratio. The copper price has crashed too, which I think is another important indicator out of China. I think the copper price last time I looked was $2.65 a pound. down. That's almost to the level of some of the lower cost.
Yeah, and we peaked at over $4 back in 2011.
Yeah, it was over $4 for a long time. I think maybe it got to like $4.30 or $4.50, and then it crashed pretty soon after that. But I mean, China has been a lot of the copper bulls won't talk about this, but my opinion and research of the copper market was the majority of the demand side for copper has been central planning China.
Yeah, and another area is some of the infrastructure stocks that have benefited, like a Caterpillar. Caterpillar reports earnings before the market opens on Monday. That'll be something that we can watch, and we'll also see with state and local and federal budgets stretched. I think it's going to be tough to for some of these infrastructure projects to be built. So that's an area that's certainly worth watching.
So changing topics, in December of last year, in 2018, you wrote an article for Dr. Marc Faber's newsletter, the Gloom, Boom, and Doom report, and you wrote "Shorting the Everything Bubble." The article's there. What do you think it's a lot more difficult now than in the past to be short? Because you were telling me a story about 2008, how you and Bill were using put with your trade clearer to short, but I've heard from other hedge fund managers who were using like Goldman Sachs as their clearing for trades, that they were outright short stock, and then the rules got changed, right? So their trades got canceled, and so they had profitable trades and they were taken away. Do you expect those types of games to happen maybe in the next crisis?
Could happen. I mean, that's why we try to keep it. Back then, people were using credit default swaps, and we never did that. We were concerned about counterparty risk, so we just kept it plain vanilla, and there were really no problems with put options back in 2008, and so I don't expect there to be really problems this time.
So in your article, you also wrote it's different this time. Why do you think it's different this time? Is this mostly because of central banks that are starting to drastically reduce their balance sheets and they're out of ammunition?
I think that the debt levels are different. I think if you look at the last time in 2008 and 2009, there were some buckets that filled up, and this time I don't think there really are. I think the debt levels are too high. The baby boomers are now getting into retirement, and they're going to be just really tapping into the system. I mean, we've got benefits with Social Security, Medicare, and Medicaid over the next 10 years, $31 trillion we're going to have to come up with. And, of course, the money hasn't been set aside, and the government is sitting on $21 trillion in debt. So, that's a very different prospect than what the markets were and what the central bankers were looking at in 2008. What do you do for an encore? So I think we're probably a little bit close to maybe the end game this time, and I'm not sure that we're going to have just a nice, clean, sharp correction in the market, bear market, and then you just buy the dip and everybody's happy, everybody's made whole in a couple of years. This could be something that's definitely more drawn out.
So you think then that in the drawn out scenario, people would start to question the economic and political elite? So the central banks then would try QE programs or asset price inflation again, and then it wouldn't work? That would be some type of scenario then?
There are so many scenarios. You almost you can go crazy trying to think about how many different ways this can play out. I mentioned the Covington school incident down in Washington D.C., and that could be something that changes the whole political direction. You see there is the anti-Trump hatred is becoming emboldened, and it's becoming radicalized, and so you think about, well, how can this all play out? And it can take so many different twists and turns. So we could, politically, you could start to see the left sort of alienate. I think the anti-war left is already starting to move to the right. They're getting more radicalized. You could see a shift there, and I don't know. You could get a bigger coalition on the right, and then will that be anti-Fed? I don't know. It's really hard to say what public opinion is going to look like. I mean, we do know. I think it's pretty safe to say that the elite they're all in. I mean, they're committed to this course. They're going to see it through. They're going to double down. They're going to triple down. They're going to be the last ones that say, hey, we were wrong. Sorry, folks. They are, and I mean, you even see this with this whole incident where some of the people on the left, despite the fact that the full video is out there for everybody to see what happened, they still see what they want to see, and then they double down and they triple down. And so, I think the central bankers they are committed to this. There's no way they're going to change. The question is, will we wake up? Will we be able to? Will enough people be able to wake up, connect the dots, and realize, we've been fed a bill of goods here, and we need to do something about this.
So, Kevin, it sounds like in a perfect world for the central bankers, they want to be able to keep the level of control they have, maybe even get more control, and they want like a controlled currency devaluation with like a gradual amount of inflation or stagflation with the currency devaluation, misallocation of capital, and then, the political part of this is taxes are going to be raised. But I think what you're seeing now is in the developed world, in the U.S., and in people are revolting against taxes. So in the U.S., whenever like a state like Illinois, who has an enormous unfunded liability and pension fund crisis, they have shortfalls. They try to raise property taxes, but people leave the state like in rapid amounts. And you're seeing the same thing also in Europe.
Yeah, exactly. I mean, and this is why taxing the rich is not going to work, especially in a world that's become really it's become a smaller world. It's become decentralized with the digital revolution that's going on. It's a lot easier for somebody who's wealthy to just pick up and move. It's not so easy for somebody who's not wealthy, for somebody who's poor. But this idea of taxing the rich, you're just going to you look at what happened in Venezuela. This was the whole mantra. Well, we can just go after the wealthy. Well, the wealthy left. They just left the country. They were the first ones to leave. Not all, of course, but enough of them did. So yeah, whether it's people leaving Illinois or people leaving New Jersey and Connecticut, going to moving to Florida, or people leaving California, moving to Texas, and if they really, if for some reason, and I have a sense that maybe we're not going to go down this road, but it's almost a coin toss. I mean, I'm not going to stick my neck out and predict it, but if we do go down that road, it'll be a complete disaster.
Well, I think, a lot of people are willing to vote if the politicians are so desperate. If politicians promise them enough stuff, they don't care if other people are being taxed, but we'll have to see how this plays out. I'm very worried about the future of the country. I think a lot of the politicians, Kevin, want to push, European socialism on whatever's left of freedom and low taxes states in the United States. So I hope I'm wrong about this, but it's looking pretty bleak.
Yeah, and, you even look at the whole shutdown, and now there's just so much pressure, on Trump to kind of cave in, and his ratings go down, and this is the thing. I think people, Jason, you look at the debt levels that we've had, and really in terms of the public debt to GDP, of course it peaked at a little over 100% in World War II, and then it dropped down to around I believe 25% back in the 70s, and then it started going up under Reagan, and it's gone up since, and here we are approaching 100% again. And this has been, when you think about people's how long they've lived, most people now our age are looking. I guess I'm a little bit older than you, Jason, but still, they've only seen that the government has been able to keep raising the limit on their credit card. They've never seen a world where they've reached the limit. And here you look at what's gone on with this little squabble over the government shutdown, and they're all crying, "Oh my God, the sky is falling. The worst thing that could happen. We've shut the government down." Well, it hasn't been the end of the world. It's been 34 days, and yet nobody's really thinking about that. But we are going into a period. I think this is really safe to say that over the next 10 years, the credit card will be maxed out, and there will have to be tough choices made. Are we going to be in, I don't know how many military bases we have in over 100 countries around the world? Are we going to be able to maintain this, or we're going to have to choose between maintaining the empire or sending out Social Security checks to the baby boomers. They're going to have to be tough choices. I don't think people are really prepared to deal in that kind of environment, but that is the environment that they're going to have.
Yeah, I agree. There's going to be a lot of tough choices in the not-too-distant future, and it's not the end of the world what's happened with this government shutdown unless you're a federal government employee and you've been living paycheck to paycheck and didn't save any of your money.
Yeah, but there are, I think, and again, you think about people, anybody who's 25 years old, what is their experience with airport security? The government provides it. Now, I'm older. I remember that a time when it was done privately. So, we should be asking questions about, do we really want to rely on the government? Because look at what can happen. The government can run out of money. They can, they can shut things down for political reasons, whatever, and there's a risk there. So, really especially if you look at the airlines, from their business model, they would want private airport security. This sort of ties in with what's gone on with trade in China. Do the Chinese, now they realize there's a risk. There's a risk that trade can be interrupted. So do they really, their supply chains, do they really want to be so dependent on U.S. companies? So, even if this gets resolved, which it probably will, the damage has already been done. There will be a realignment. So I'm just hoping that people will realize in the shutdown that, hey, you know what? Maybe some of these things that obviously airport security is a service that is a vital service that's needed, but hey, can we do this privately?
Yeah, I agree with you. The federal government's already way too big. It's restricting competition. We need more competition for innovation and to lower prices. And it's not happening as much as people think it should in the private sector. Well, some people don't think that it should, but as someone who likes free market capitalism, the best way for beneficial deflation and lower prices is more competition. And we just have too many industries now, Kevin, where there's only a handful of companies basically who dominate all the industry.
Yeah, and yet there are still sort of natural monopolies out there. You always I like to give the example of shellac. If you go to a Home Depot and ask for shellac, there's only one brand, Zimzer, and it's you see these oddities. Of course, they tend to be relatively small examples, but let the market work. The market. Everybody worries about concentration and monopoly and things like that, and despite the fact that there's been so much intervention, and the intervention, of course, reduces competition, the market finds a way. I mean, it's like water running downhill. It will find a way, and it wasn't that long ago. It was 20 years ago that everybody was worried about Microsoft, and they were the target of antitrust suits, and Google. Nobody was even thinking about Google, and they come along, and the internet comes along, and Microsoft really misses a lot of that opportunity, and it's taken away by an upstart. So the market works. We just need to give it a chance.
Yeah. So now Google has monopolies on almost all of internet advertising, along with Facebook. So they own YouTube, and if they want to bully people and demonetize my videos or restrict the growth on it, they can do that now, unfortunately. So Kevin, as we wrap up here, one more question for you.
Sure.
So since you've been a professional short seller for so long, have you noticed that it's a lot easier for some of these companies to get away with accounting fraud now? Do you feel that the regulators are maybe waiting until the company's basically either knocking on death's door or the company's already bankrupt before they go in and they take action on the company?
Well, certainly the accounting is aggressive. There's no question about that. But it's sort of like the rating agencies. If we're doing this, we're all big boys. We know. We're facing aggressive accounting. We're facing the government against us, uptick rules, whatever it is. Banning short selling. The central banks suppressing interest rates. The Fed put. We're faced with it. Just goes with the territory, and I don't really get too worked up over it because I keep reminding myself that these are the things that create opportunity, and that's what we want to focus on. And this we can't have it both ways. We can't complain about the manipulation, and not delight in the fact that, well, this has created bubbles and it's created opportunity on the short side. You can't have it both ways. So we'll look at the positive and we'll accept that and try to make a silk purse out of a sow's ear.
So from studying you and listening to other interviews with other successful hedge fund managers and traders on the short side, it sounds like short selling is a lot harder than being a long investor and trying to find a small or medium-sized business that grows revenues, earnings, free cash flow, good margins. It sounds a lot harder. There's a lot more variables to account for on the short side.
I don't know. I think it's harder. It's harder to endure because obviously markets tend to go up, especially when you're in a period of asset inflation, and this is something, and debt buildups. This is something we've experienced really since the late 70s, early 80s. So it's been a really brutal environment for short sellers. There's no question about it. But at the same time, I think the process is very similar. I just think it's the mirror image of the long process. Being a good short seller, I think, can help you be a better long investor. You are. What are we looking for? On the short side, we're looking for bad business models. Business models that are heavily dependent on credit. They are capital intensive. They're very cyclical. They have a tremendous amount of competition. The barriers to entry are not that high. You look at what are you going to look at on the long side? The opposite of those things. You want you want high barriers to entry. You want a business that where the company is not dependent on financing and credit and can self-finance. So I just think it's kind of it's the other side of the coin. That's all it is. It's really a very similar process. I don't think it's really much different.
That's some very interesting insights. I think our listeners will really appreciate that, Kevin. You drawing from your 30-plus years of investing and trading experience. You also have a lot of long investments. We didn't get time to talk about those today. I want to thank you for your time today, Kevin. And if our listeners want to follow your work, I know you occasionally put out some articles. You published on Lou Rockwell before, and you also tweet quite a bit, right?
Yes. Yeah. So you can follow me on Twitter.
Okay, and I'll attach your Twitter handle in the information section of this interview. I want to thank you again for your time, Kevin. Great insights, and we'll finally see in the near future if the everything bubble is going to finally burst.
Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street for Main Street YouTube channel if you have not already done so. Thanks for helping Wall Street for Main Street pass the 20,000 YouTube channel subscriber milestone despite YouTube censorship. Hopefully, we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down this channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street for Main Street email list that's on the wallstreetformainstreet.com website and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to wallstreetformainstreet.com. That's wallstformainst.com website, where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing my loyal listeners with some of the best information, analysis, and financial education available out there, free or paid, as I work to grow the podcast and also get my educational technology company funded.